So we're ending February on a down note. Worries are hanging over the market about AI disruption and massive tech spending on things like server farms and data centers. We also, of course, have geopolitical tension amid speculation that the US will launch an attack on Iran in order to pressure that nation to curtail its nuclear program. We're joined by Chad Larson, Senior Portfolio Manager with MLD Wealth at CG Wealth Management. It's great to see you. Thanks very much indeed.
Pleasure having me.
So the U.S. economy, U.S. market is still bare, or as of today, was barely up in 2026. And I was amazed earlier this morning when I checked the Mag 7 stocks, all of them were down at least a bit this year.
Yeah, and I think, I was here a few weeks ago and, everyone's talking about a rotational trade that's happening. So, yeah, the market's seeming to go up-ish, but the leadership is looking to rotate. Even with NVIDIA's earnings, they were a beat. They exceeded expectations, and the market still traded them down. I think you have these. We've been talking about a crowded tech trade for a very long time, and expecting the same thing to do the same thing over a period of time will catch people off guard. And so you're just seeing people not fatiguing from them, but where else can they go from here? So a lot of sector rotation continues to kind of be the thematic that we see in the market.
Right. What areas of the market do you think investors will be exploring from now?
Well, we're seeing it. Like we're looking at the Dow, keeps trying to inch its way higher. Doesn't look to be tech leadership driving. It was the Mag 7 that took us all to the promised land for the last number of years. And so it's sector rotation. You're seeing that into the industrials. The materials have obviously led the way. Oil's been creeping higher. But more than anything, when we see some of the earnings coming out, more than anything, it's guidance is driving the market value. Good results are good results, but they're expected now, and we're starting to see people rotate for predictable, stable cash flows. Boring is beautiful again. And I think, to jump in, you did talk about, we are experiencing heightened volatility. You're starting to see the VIX bounce around intraday and really start to whipsaw people's emotions. We've seen the largest mobilization of a military force since 2003 into the Gulf. That is significant. Obviously, some geopolitical pricing coming into oil, but that bodes well for Canada. It's a resource market. Gold, energy, international equities continue to catch a bid from stability, and the gold complex looks great.
When clients talk to you, do they say, look, I've made money in tech stocks, those that have held them, but are they getting nervous?
They absolutely are. And I think it's interesting, we're in the early front part of the calendar year. As people were already contemplating these large embedded gains in their portfolio into the end of the year, everyone kind of wanted to wait into the new year, at least kind of slow down the tax man, at least a year until they had to come back to collect, so to speak. But I think so often when something's worked so well for you for so long, saying goodbye to it is hard. So it's a really reframing of how people's emotions are positioned through this. But there are nervousness. Calls are nervous.
But of course, a classic mistake is selling your winners.
Yeah. I love that you said that. I think a lot of investors are very guilty of cutting their flowers and watering their weeds. It feels really good. It feels really good and responsive to say you did something good and that you took a profit. But good things can compound. An investment thesis doesn't change because of price action. And I think a lot of times, people are very much guilty of hanging on to their losers or selling their winners too quickly.
What about Canadian banks as a group? Can you comment on them? Do you like their prospects?
Yeah, I think I can comment to them with respect to they're the bellwether of the Canadian economy. I wouldn't, purport to get into. We saw RBC report. It was a fantastic print. Reading through that, we saw loan loss provisions are in line. Mortgages are staying okay. I wouldn't say it's not super healthy, but it's not super sick.
Maybe we can put up a 5-year chart for the Canadian Bank Index. I mean, not too long ago it was hitting record highs, and it's near record highs. We are seeing generally selling across a lot of stocks today.
Absolutely. I think the 5-year chart looks great, but again, where do we come into this today? I think there's general concern in the housing market in Canada, and banks are obviously that bellwether to the economy.
Yeah, that's quite a drop actually today, isn't it? 2%. Yeah, but from near record highs.
Yeah, the further you step away from any chart, it gets pretty. It looks nice, but and we're seeing a lot of those. A lot of the calls that are coming in is looking at at the stocks. Looking at software companies as this transition away from AI. Is it going to be the eater of software? It's some bumps along the way for sure.
Yeah. What is your view on energy stocks? Are you overweight, underweight? Can you generalize?
Yeah, I can. Listen, we've even seen through, obviously recently with the price action of Brent crude hitting all-time highs because of geopolitical uncertainty in Iran, you saw energy stocks doing better even when oil was down low. I think there's a move for scarcity. I think if you look at Dave Zabunka at Canoe does a really incredible job at framing this thesis. You're seeing less and less commodity owned by fewer and fewer. We're seeing almost like an oligopoly set up where companies are getting very big and there's a scarcity. There's singular companies now are controlling massive parts of resource, and that bodes well for the industry as a whole. We're seeing private equity active in the space. We're seeing M&A happen in the space. So yeah, I would say we're bullish the energy equities, but near term, volatility in the commodity price.
As you say, the oil sands have been consolidated partly because foreign oil companies have pulled out. Yeah.
There's just I think in this modern time, a lot of them look to be maybe even re-rated. These are flagship legacy assets that would they won't be discovered again, and a lot of them have reserve lives like upwards of 90 years.
Yeah.
The conventional wisdom. I've been doing this over 22 years, trading at a multiple of cash flow 5 or 6 times. When you have assets that are 90 years in length, that's right. A whole different ballgame.
The economics are completely different.
They're forever assets.
Chad, thanks very much.
Pleasure.
Chad Larson, Senior Portfolio Manager at MLD Wealth at CG Wealth Management.